Hello and welcome to IMF and Economic Policy. My name is Dr. Brown and I'm going to be talking about the IMF today. In Nigeria, the IMF is a very controversial institution, especially amongst people in the age group of that 60 to 70 or 80. A lot of those guys, when you speak to them about the IMF, they say things like, Nigeria would never ever be disgraced or humiliated by the IMF. It's evil. We'll never allow ourselves to fall into that position again. We'll never be subdued. And people have these really emotional reactions, like the impression that I just gave. So through the next few minutes, I'll just be sort of talking about the IMF, trying to understand both sides, from the people that think the IMF is evil, and the people that have found the IMF a very helpful and useful institution. So this is how the flow of this talk is going to go. I'll start by talking about macroeconomic stabilization and the role of the IMF, and then the IMF approaches to stabilization. In Unit 3, I'll be speaking about alternative approaches to stabilization. Unit 4, I'll be speaking about the role of the financial sector and how the IMF learned the hard way to focus a bit more on the financial sector and its role in stabilization. Unit 5, I'll be talking about the institutional responses to the financial sector, including other institutions that have been involved in financial stabilization of the financial sector outside the IMF. In Unit 6, I'll be talking about some of the challenges and controversies and maybe sound like those 65 and 70-year-old men a bit. Then finally, I'll be finishing off with stabilization in low-income countries, which is a bit different for a number of factors that I'll be describing, and the challenges for low-income countries. So I've spoken about stabilization in almost every single unit, so I'll just define it. Stabilization policy is a strategy enacted by a government or its central bank, or the IMF in this case, which is aimed at maintaining a healthy level of economic growth and minimal price changes. In the language of business news, a stabilization policy is designed to prevent the economy from excessive overheating or slowing down. So I'm going to be mentioning stabilization a lot, and I just wanted to give you the definition before going into the unit. Unit 1. Unit 1 aims to focus on the operations and structure of the IMF. So the IMF was established in 1944 after the World War. People, especially the advanced countries like America and the UK, wanted to really promote monetary stability. And it was established with a mandate for trying to solve short-term balance of payment challenges. The IMF does have a dominant role. So when the IMF comes in and lends, it tends to attract other lenders. And the articles of its agreement are its founding constitution. It's run by the executive board at the highest level, and then the board of governors, and then the managing director and the deputy managing director. And it has three main roles: surveillance, financing, and technical assistance. And we'll be looking at those in closer detail as we go through the module. And some of the financing that is available from the IMF, some of the names of the different types of finance are standby agreements, precautionary and liquidity credit lines, rapid financing instruments, extended fund facilities, and concessionary lending. And again, we'll be hearing a lot more about these particular products that the IMF uses to in its stabilization and uses to help stabilize countries as we go on. One thing that I'm going to mention again in the IMF introduction is the role of SDRs. SDRs are actually the currency of the IMF, and every country has an allocation of SDRs according to the quota that they have. So there's a diagram here in the middle that talks a bit more about SDRs, or special drawing rights. And then there's sort of a note showing, the special drawing rights as a currency. And it's basically like a basket of currencies that is used to get the value of the SDR. How IMF conditionality is applied. So, one of the big sort of bugbears that people have about the IMF is that its loans come with a lot of terms and conditions, and some of those terms and conditions can be quite intrusive or invasive. Some people see it as that. And I've spoken about some of the things. They put specific criteria, performance criteria, and indicative targets. And then you have program reviews as well, and the loans are given usually in tranches, and you have to meet, each country has to meet the requirements before they can be given a loan. And the executive, sometimes a country doesn't meet the requirements, so the executive board has to make a review, and sometimes the executive board refuses the waiver and they don't get their additional tranche. So this is why, I guess, part of the reason why the IMF loans are sort of controversial. And also there are actually some prior activities, even before getting the loan, that people might need to engage in, even prior to the first tranche being doled out. Unit 2, the IMF's approach to stabilization. And I think the biggest thing that I'd want to sort of talk about is the Mundell-Fleming model. The Mundell-Fleming model looks at the role of the IS curve, which is shows the relationship between input and output, the LM curve that shows the relationship between the money supply and the and output, and the BP curve, which is the balance of payments curve. And the Mundell-Fleming model actually shows when there's perfect capital mobility and when there's imperfect capital mobility, where and in different scenarios, so where there's a fixed or flexible exchange rate, how those different factors, both the IS curve, the LM curve, and the BP curve will move, and what different effects that will have on the economy. There's also the Pollack model, and the Pollack model is a behavioral model, and it actually argues that there are no direct linkages between changes in monetary variables and the external sector of the economy. And the main point to remember about the Pollack model is that the Pollack model shows how an increase in credit creation will result in a decline in international reserves. So that affects the balance of payments. And the equations are below, showing the velocity of money and the money supply. But I won't go into that. But I think the main thing about the Pollack model is just to remember that an increase in credit will result in a decrease in the level of international reserves. So how does the IMF prepare the framework for stabilization? The process by which the calculations are made by the IMF to determine which stabilization policy to recommend for which country is called the financial programming approach. And they look at four main things. They look at the banking system, they look at the government budget, they look at the balance of payments, and they look at the national income account. And from that, they developed their financial programming approach, remembering that there's three main roles for the IMF: technical assistance, financing, and surveillance. So whenever they're doing their activities, these are the main things that they look at. And sometimes when they do a surveillance visit, they produce something called an Article 4, which has all of those details inside of the specific country. Steps in financial programming. So there's 10 main steps that the IMF uses to put a financial programming protocol in place. And I've written down all the 10 steps, but I think some of the most important ones are considering the level of import in the country. And then the most controversial one is around devaluation, and I'll be talking about why it's controversial later on in this course. And then also comparing the level of credit extension to demand for domestic credit, and then being able to bring all these 10 variables together and agree on implementation. Unit 3. I think this is the most interesting unit because it kind of shows that there are alternative ways of thinking apart from the IMF's way of stabilization. And there's a group called the Structuralists that I'll be talking about here that have a very different way of thinking about stabilization. So Pakistan has had a difficult relationship with the IMF and borrowed from the IMF for 15 years. Now, this might not sound that extraordinary till you remember that the IMF was actually created for short-term funding. And the IMF also has a um, uh, independent evaluation office, which is completely independent from the institution of the IMF. And they were quite critical in their report, actually, about how the IMF has intervened in Pakistan. So when we're talking about some of the criticisms, we'll be coming back to the findings in some of these IEO reports. What are the types and sources of shock that prompt the need for stabilization, internal shocks and external shocks? And then the criticisms of IMF programming that I spoke about in the first slide. Sometimes they've been criticized as having too little regard for the financial sector. They put quite strict measures in place around fiscal and monetary tightening, which kind of increases poverty. It has a huge social cost. Some people complain that the IMF oversteps its mandate and starts almost becoming like trying to become like an alternative government to the countries that they intervene in. The nature of the conditionality as well, the structuralists complain that it's not practical for emerging markets. People accuse the IMF of having a one-size-fits-all approach. Developing countries are not very well represented in terms of the IMF leadership. And I think the greatest one that I've written in capitals is, a lot of the countries under IMF programs fail. They don't grow and they don't get stabilized. So I think the biggest criticism of the IMF is the one written in capital letters that it doesn't always work, especially in emerging and low income markets, and sometimes makes things worse, like Pakistan would probably claim. So I think that these are criticisms to bear in mind as we look at the alternatives. So the structuralists have an alternative model for stabilization policy that takes macroeconomics into a lot greater consideration. And this was sort of initiated by academics in the Latin American countries that have had a lot of experience with the IMF. Now, the IMF initially, in the early days, always viewed inflation as something that could be isolated and controlled by a particular policy. But the structuralists actually view inflation as an inevitable part of development. And the reason why it's inevitable is because of three constraints: because of the food supply constraint, because of the government spending constraint, and because of the exchange rate constraint. Um, a monetarist, a typical sort of traditional IMF person would see inflation as directly proportional to the demand for money. So the more inflation there is, um, the more demand for money, the more inflation there'll be. Whereas structuralists actually see other causes and don't see the demand for money as constant. The biggest sort of points of diversion between structuralists and monetarists is around government spending. Monetarists, like the traditional IMF approach, was to halt the growth in the money supply, tighten up fiscal and monetary policy. And the structuralists disagree. They say things are more nuanced. It's difficult to collect tax in poorer countries, and money creation is important for the countries, and state spending is very important. So the structuralists criticize the IMF for being too short-term in its approach, and also through this, tightening and lack of spending, they're actually causing unemployment and stagflation. Unit 4, stabilization and the financial sector. So I've put a beautiful picture up of Thailand because this was where the 1997 emerging market crisis started. And I think it was IMF's first introduction into just how important the role of the financial sector is in certain financial crises. Because the emerging market crisis originated in Thailand, and the crisis didn't start in the fiscal sector. It didn't start because of a war. It started in the financial sector. Um, Up until the EMA crisis, the main focus of the IMF stabilization programs was just to decrease government spending and reduce pressure on the money supply, reduce inflation, and reduce pressure on reserve. But the EMA crisis showed that the financial sector, you know, is prominent, is a prominent consideration for anybody looking at stabilization. And the crisis in the financial sector spread to the real sector quite quickly. What happened in Thailand was they started getting a lot of foreign direct investment and foreign portfolio investment in foreign currency. And it very, very quickly outstripped even the domestic sector's ability to borrow. And because there was a fixed exchange rate, um, the lenders who were lending out this foreign currency and the projects that this foreign currency was financing got into a sort of moral hazard where they believed that since the exchange rate was always going to be fixed, then they'd be able to pay back. However, the flows reversed quite suddenly. And when they did, it led to huge foreign exchange debts that the government couldn't pay. So they were forced to devalue. And of course, that made it a lot more expensive to pay back debts in dollars. So default started and that contagion spread. So financial policy is very different from monetary policy in that it's focused on strengthening bank regulation, corporate governance, and capital adequacy, etc. And if these things had been in place in Thailand during the EME crisis, it wouldn't have been so severe as it turned out to be. This is just about exchange rates and knowing that there's different types of exchange rates between fixed and floating. There's also target zone crawling peg and fixed yet adjustable exchange rates that can be used depending on the circumstances. Again, the role of the banks during the EME crisis I've already spoken about, and the way that moral hazard sort of played a role in making the lenders and the players in the economy overly confident. The global financial crisis in America was quite similar because it started in the subprime lending market, and then that made the banks confused. They didn't know which banks that they could lend to, and it hit the interbank market as banks stopped lending to each other, leading to the credit crunch. The governments responded in three ways: expansion of financial safety nets, massive fiscal stimulus, and direct government intervention for the failing institutions. But there are certain similarities between the two scenarios I've described, both the EME crisis and the global financial crisis. One, it was characterized by regulatory weakness. Two, weak financial institutions. So that highlighted the need for stronger market conduct against unscrupulous agents, especially in the global financial market, where you saw some people do things that were on the borders of legality. Unit 5, institutional responses to the crisis. There were three main institutions that responded to the crisis: the Bank for International Settlements, the Financial Stability Board, and the IMF. And the IMF went through some immediate reforms and some long-term reforms on the outside, but also had to be quite introspective and, in terms of their own capacity, actually undergo some internal reforms as well. The Financial Stability Board and the Bank for International Settlements also had roles to play in terms of looking at financial sector stability and the capacities of central banks, respectively. So this unit looks at capital account liberalization, capital controls, and criticisms of the IMF arising from the crises. And in terms of capital account liberalization, it has a huge amount of advantages. You know, increased mobility of capital because as a result of portfolio diversifications, it means that countries can borrow when their incomes are low and pay back when they rise. There's increased competition for the domestic market. It allows governments in underdeveloped financial markets to raise capital, but these advantages only work when there's freely available information and strong reforms macroeconomically. Otherwise, what happens in East Asia happens where you have this sudden liberalization without those strong reforms and without that freely available information, which leads to adverse selection, moral hazard, and also herding behavior. And that herding behavior leads to pretty large swings of capital in and out of the country. Are capital controls a good or a bad thing? And when countries are in crisis, should they reinstate their capital controls? Chile and Malaysia had to reinstate their capital controls for different reasons, and they did that quite successfully. So that's something to consider. There's a report called the Meltzer report that's very critical of the IMF, and it gave 12 main criticisms. And the reason why I've put Villanelle from Killing Eve is because this is how I remember the 12 criticisms, because she plays an assassin actually in this TV show, and the group that she works for is called the 12. And the Messler report was one of the most critical reports of the IMF to come out, and it had these 12 very sort of pointed criticisms of the IMF as an institution. So I've combined the contents of Units 7 and 8 because I think they're quite similar and quite interrelated. And these final two units talk about the IMF and stabilization and challenges that it faces in low-income countries. So first, let's remind ourselves about the non-concessional lending facilities. So these are lending facilities that the IMF has that aren't particularly directed at low-income countries. And there's 5 of them, all subject to conditionality and all dispersed in tranches apart from the flexible credit line. All the 5 non-concessional facilities are subject to conditionality and are dispersed in tranches that are subject to review before the next tranche is released. And the 5 are the standby arrangements, which are more or less the sort of foundational and one of the oldest forms of IMF assistance. So you've probably heard about the SBA before. And the SBA is given to tackle short to medium term balance of payments problems. And then there's the extended fund facility, which is more medium to longer term balance of payments problems, and these can be extended for up to 3 years with, I think, a 1-year extension in addition to that. There's a flexible credit line, which is sort of potential and actual balance of payments needs, crisis prevention and resolution. And as you can remember from the last slide, that's the one that I said isn't necessarily subject to the same levels of conditionality as the rest of the non-concessional lending facilities. And then there's a precautionary and liquidity line, which is for countries with sound economic fundamentals, but still some remaining vulnerabilities. And then there's a rapid financing instrument, which is urgent balance of payment needs, shocks, disasters, commodity price shocks, post-conflict situations, and other emergencies. So those are the 5 non-concessional lending facilities, and I thought that it would be useful to address the non-concessional lending facilities before moving on to the concessional lending facilities that are sort of more specific to low-income countries. So in 2009, after the financial crisis, the IMF underwent a series of reforms. And one of the things it did was it reconsidered the support that it gives to low-income countries and came out with a suite of products better suited to the diverse needs of low-income countries, and also learning from the financial crisis. It learned that these low-income countries are actually, at a heightened level of exposure to global volatility and sort of fluctuations in the global markets. So there are 3 concessional lending facilities. Remember that the IMF has its non-concessional facilities, which we discussed earlier, and now we're talking about the concessional lending facilities. These are lending facilities that are targeted at low-income countries, and they are namely the extended credit facility, the standby credit facility, the rapid credit facility, and there's one non-financial support tool, which is the policy support instrument. And this was, these were designed as part of the new diverse set of instruments to support low-income countries through concessional lending. And before low-income countries can have access to these concessional lending facilities, they must indicate how the facility or how getting on one of these programs will reduce poverty and enhance growth. So apart from the concessional lending, which is currently, I spoke about on the last slide, which is currently provided under the umbrella of the Poverty Reduction and Growth Trust, and I'll talk about trusts shortly, there's also the debt relief. And the debt relief is currently supported under the Catastrophe Containment and Relief Trust. And recently, because of the COVID-19 epidemic, you may have heard IMF officials and officials of different countries talking about low-income countries accessing some form of debt relief under the Catastrophic Containment and Relief Trust because of the COVID-19 epidemic. And previously, the most famous, probably, debt relief program in the world was the Heavily Indebted Poor Countries Initiative, or HIPC, where a lot of countries, including Nigeria, received debt relief. And it's been running since 1996 and is sort of largely completed. So in terms of the support that the IMF can offer to low-income countries, there's a concessional lending under the Poverty Reduction and Growth Trust, and we discussed the different instruments that it uses on the last slide, and then we also have the debt relief, currently under the Catastrophe Containment and Relief Trust, and previously under the Highly Indebted Poor Countries Initiative. So about those products, the extended credit facility, the standby credit facility, and the rapid credit facility, what makes them different from the non-concessional facilities that we discussed at the beginning of this unit? Well, number one, the interest rates are at a low level for all of the facilities under the PRGT. So they go up only to a maximum of 0.75%. Reviewed every year, and the rapid credit facility, which is used in conflict and disaster, is permanently at 0% interest. So these are very generous loans with very, very low interest rates, designed to help the world's poorest countries when they have these balance of payments problems, particularly due to conflicts and disasters. I've been speaking about trusts and what what the trusts are and how they relate to low-income countries. So the IMF acts as a trustee for all the trust funds, and the trusts actually support the concessional lending efforts of the IMF. So the trust that supports the concessional lending is separate from all the other IMF accounts and is self-sustaining. And under the trusts, we have the PRGT Trust, which disperses some of the concessional lending products that we spoke about. And then we also have the HIPC Trust from 1996, which deals with debt relief. And then we have the more modern CCR Trust that also deals with debt relief, which is a newer debt relief program. Large, powerful countries like the UK and the US are able to conduct stabilization without the IMF. Even China and South Africa have been known to, when they didn't have foreign exchange problems, conduct their own stabilization. So most of the focus actually has been on poor countries in terms of stabilization for poor countries. And it's different. So stabilization in middle income countries is about helping them manage their capital market flows. However, stabilization in poor countries, especially in sub-Saharan Africa, is about maybe even helping them to access international capital markets for the very first time. So when we talk about stabilization, most of the focus being on stabilization for capital market flows, we forget about these very, very poor countries that might not have those capital market flows in the first place, and they're going into that form of international market liberalization for the first time. Traditional IMF programs are deflationary and demand compressing, and have a tendency to worsen poverty. And that's why in 2009, these reforms came in to highlight the need for social safety nets and social programs. And this is in addition to the fact that poor countries have little or no voice in the IMF, even though they have the most needs. So in terms of debt relief, I just wanted to speak a bit about that. I know we've spoken about the HIPC program and the Catastrophic Relief Fund program. And there's two stages to debt relief. There's the stage one, which is to demonstrate capacity to prudently use the assistance. And then once the decision point is reached in stage two, the countries now have to demonstrate and implement a poverty alleviation strategy. 36 countries have received debt relief, and qualifying thresholds include things like unsustainable debt to export ratio or an unsustainable debt to revenue ratio. Challenges with highly indebted country debt relief. Number one, you may think that debt relief means relieving all the debt, but actually the debt relief is only to a point that stakeholders consider the point of sustainability. So it's not all the debt that's actually forgiven. It's a proportion of the debt until it gets to the point where stakeholders feel that this is a sustainable level of debt for this country. But that's very subjective. So one of the challenges is actually post-completion point sustainability. When you get to the completion point, is it really sustainable for the country? And then when debt is forgiven, does it really go into these sustainable development goals? Does the money saved go into development? And then for creditors that aren't part of the Paris Club, and aren't part of these agreements. And that's why I think under the reforms that we discussed when we're discussing the financial sector reforms and financial sector assessments, we said that collective action clauses were important for bonds, because that doesn't mean that one creditor that isn't part of the um, the Paris Club Agreement can go behind the majority of the creditors and cause problems with the negotiations. But that is still a problem with in the absence of these collective action clauses. And just a little reminder, I wrote in red so I don't forget, the fact that technical assistance is also a form of support. And we mentioned that, and that was highlighted on the slides when we're discussing non-concessional lending. Just to round up, the IMF's quota system actually gives developing countries very low levels of voting rights and therefore low influence. The quotas also affect the IMF currency, the SDRs, and because they don't have very much in terms of quotas, because the quotas are calculated using GDP, openness of the economy, etc. The quotas are calculated using economic measures. So developing poor countries don't usually get very much in terms of quotas, so therefore they don't get very much in terms of SDRs. I think highlighting again the importance of these social safety nets and programs that seek to protect vulnerable individuals and households from poverty. And just remembering that developing countries only account for 30% of votes at the IMF, and you need about 70% to make much of a difference. So I think that America has the most voting rights, followed by the UK. And together they probably, the America and the EU probably make up about 60% of the total vote or more. Developing countries have very, very few votes, so they don't have very much influence on how, these programs are rolled out. So that's the end of our talk about the IMF. I hope that we've been able to cover some really important aspects from the structure of the IMF and the board and the role of the deputy managing director to this new IMF currency known as the SDR, to how the IMF actually implements stabilization programs in practice, and what are the factors considered when IMF implements these stabilization processes, and how those stabilization programs have actually changed over time. I think one of the more interesting points from the earlier units was about the role and debate over capital controls. Are they a good or a bad thing? And economists are really split as to whether capital controls work or they don't work, or whether they are effective or not. But I think that most economists would agree that they do have a role in developing countries at some points temporarily. However, I think economists are more certain that they probably don't have a role for advanced economies. How to liberalize and the steps to liberalization, the criticisms of the IMF and how it's taken on some of those criticisms, and how perhaps other things haven't changed. And then finally, we ended with the role of the IMF in low-income countries. Like I would say, like Nigeria, but the IMF actually doesn't consider Nigeria a low-income country, even though it has the highest number of extremely poor people in the world. But for low-income countries, sub-Saharan countries, the countries that surround Nigeria, definitely, how does it support us? How are we able to influence decisions at the highest levels of these multilateral organizations like the IMF and the World Bank? And how can these institutions be how can these institutions be instrumental in lifting the millions of people across sub-Saharan Africa out of poverty and into some form of prosperity? Thank you for listening.